If you are focused on the AI market or chasing AI stocks, you must pay attention. Today, I'm urging you to look at another tech opportunity. And while it isn't AI, McKinsey says that this sector could grow by 30% every single year until 2030. I'm talking about battery metals. I first identified battery metals as a huge opportunity in 2009. And since then, lithium-ion battery prices have soared 900%. But now, with EV adoption accelerating, I'm urging folks to get in on a handful of battery opportunities. To help, I've released a brand new free report, the 2024 Battery Boom. In it, you'll find all you need to know about the coming battery metal surge. If you're a tech investor or megatrend investor that's looking to cash in on $1 billion trend, you can't afford to miss this. Just visit 2024batteryboom.com to get a copy of your free report right now. That's 2024batteryboom.com for your free report.
All right, folks, again, we're sitting down here at the annual Stansberry conference out in Las Vegas, sitting down with a good friend, a person who's been on this show several times, just got off stage giving a great speech, Meb Faber. Meb, thanks so much for sitting down again.
Good to be here, bud.
So, great speech as always. You're always a fan favorite out here. You talked about some of your ETFs and what's going on with them. Let's talk international first, though, because, I would say I follow you on Twitter and a lot of blog stuff you do, your podcast. And when you look at the international markets right now, I feel like they're at either decade or multi-decade lows compared to developed markets, especially the U.S. Is that true? Is that where we're sitting at?
If you look at the long history of global markets, and I'm talking 100 plus years, right? And you go back to, if we were sitting here, 1899, December 31st, whatever the equivalent of Vegas would have been there, New York City, sipping champagne, tea, whatever it was, talking about what do we see as the big opportunities. The U.S. wasn't quite an emerging market, but it wasn't the biggest market cap. Yeah. That would have been UK. And if you'd have said, hey, let's play some bets, who do you got this century? I would have said, first round draft pick, I'm taking Argentina. And you would have said, well, maybe I'm taking whatever. Who knows? I was trying to think of countries don't even exist anymore. Yeah. And so, and if you roll forward 100 years, Argentina, they used to call it the Paris of the West, has been a basket case, is a, fraction of the world's market cap. Now the U.S. has ascended from being, still one of the big players, but now the dominating factor. I mean, the bigger than the second biggest market cap stock market by a factor of 10. Wow. Now, as far as a percentage of the world GDP, it's only a quarter. So there's an outsized weight there. And so, but if you look around the world, there's great entrepreneurs everywhere. Yeah. You go hang out with people in Bangladesh, Singapore, Latin America, all over, incredible entrepreneurs. And so the belief that there's something in the water in the U.S., I think there is. I think there's a truth to that. But it's not as much as people think. And so if you look at many of these 45 investable countries around the world and look at the opportunity set, yes, this has been a unique period for U.S. stock returns where they've crushed it for 15 years. And we often tell investors, say, look, if you got all your money in U.S. stocks and they've crushed it, God bless you, pat yourself on the back. It's been an amazing run. But if we know anything about markets, is they go through cycles, and there's times when everything looks amazing and times when it doesn't. And so foreign markets have certainly not looked amazing this past cycle, really post-GFC. Mm-hmm. We have a fun tweet where we say something along the lines of, and I won't get it exactly right, say over the last 70 years, U.S. stock market has beaten foreign markets by 1% or 2% a year, whatever the number was, which is incredible. It ending wealth is this much versus that much, and has a huge impact when you compound for that long. How much of it has come since the global financial crisis? That's outperformance. The answer is all of it. Wow. Right? So and it's a little bit cherry-picked on the time horizon, but you've had this. If we were here in March 2009, you would have had all three opportunity sets, U.S. stocks, foreign stocks, emerging markets, all trading at super low valuations. The big difference is there's been an alligator jaw since that time, where U.S. stocks, the multiple has gone from low teens, hit a peak of 40, but it's back around 30 for the long-term PE ratio, CAPE ratio. But foreign, developed, and emerging have just flatlined. Yeah. And, investors have a short memory. And so if you go back to 2000 to 2008, foreign and particularly emerging crushed. A lot of things crushed. REITs crushed, gold, small cap value. But you have these scenarios where they trade places. And if you look at the valuations, if you look at the demographics, a lot of the tailwinds, we think it's pretty exciting time for both. We actually think it's exciting time in the U.S. too. But in general, it's probably long past due for them to take their spot as the leaders in the returns. But I would have said this a year ago. I would have said this 2 years ago. So,
but the things you talked about how it's basically flatline, especially let's concentrate in emerging markets. Flatline since the great financial crisis, but it's had better growth in the U.S. in that time frame as well. Doesn't that have to catch up? That growth that we've seen in the emerging markets, the valuations will catch up with
One
that.
would think, as you know as well as I do, sentiment in markets tends to follow price. And so as things go up, investors tend to get more euphoric. They actually pile in more rather than the opposite. And when things go down, it tends to be the reverse. Emerging markets, I know you're a tech guy. It's interesting because a lot of our value strategies, what we call shareholder yield, have been picking up tech as the number one sector in emerging markets. Yeah. And most people don't usually think of tech as a traditional value metric, but so many of these countries are down 40, 60, 80%. And when things are down that much, everything is mostly cheap, right? And so, it's a scenario where the good news is I think most of the world is totally reasonably priced. There's a lot of countries that are in these sort of low teens, single digit PE ratios. And a buddy of ours, Mark Yusko, says, he's like, look, they can look terrible and they don't have to go from terrible to amazing. They just have to go from terrible to less bad.
Yeah.
And then the sentiment starts to change, then they start to go up and the price changes. And all of a sudden you have an environment where you have room for not just investors coming in, but multiple expansion. And then you set the stage for a secular type of advance.
So, obviously, the U.S. is still perceived around the world as the safest probably country to invest in. I don't know if I agree with it, but I think in general I probably believe that. And what's now going on, obviously, in Ukraine and Russia for a while, now you have Hamas and Israel, and it just feel like this uneasiness, this negativity, this uncertainty around the world just keeps boiling more and more every day, it feels like. Do you think that will keep people away from emerging markets, stuff like that that's going on?
Yeah, but that's always been the case. It's always funny to me. I'm still waiting. I want to do this actually, so you can hold me to it. Next time I go on CBC, every single person you hear, they say, in these uncertain times, in these volatile markets, you've never once heard someone say, you know what, in these incredibly certain times,
it's true.
In these incredibly low volatile markets, this is what you should do, right? And so the future by definition is uncertain. So you have to prepare for that. We've written a lot of books on that topic alone. One of our biggest funds is a tail risk fund. And so, but as you think about it, one of my favorite charts, and this is a financial advisor's favorite chart, right, shows the Dow or just U.S. stocks for 120 years, ish. And then every year they have whatever crisis is going on. Mm-hmm. So, World War I, World War II, COVID, Zika, remember Zika? Yeah. On and on, just a list of worries. And yet over that time, you've compounded at 10%. I like to use 10% because in your head, you can say in 25 years, you're going to 10x your money.
Yeah.
In 50 years, you're going to 100x your money, which is such an astonishing concept. And we talked to young people in the speech that I just gave. I said, look, it's funny because if you say something like, the stock market's up 30% this year, it's not, but hang with me. It's up 30% this year. It's a terrible year for investors. People say, what are you talking about? And I'd say asterisk, say, well, it's a terrible year for young investors. Because if you're young, the last thing you want is the stock market to go up because you want to be dollar cost averaging and investing when prices are cheap and to have the big move when you're older. Now, if you're an older crowd, you want the opposite. You want stocks to stay elevated, to continue going up. And so it's funny because it's based on your perspective, the truth is different. And so anyway, so looking at some of these opportunity sets, particularly on longer horizons, being able to have that global approach, I think is really important. But there's always these crazy events, which we've hit Morgan twice already, but he's got a quote, and I don't know if it's attributed to someone else, but he says, every past decline looks like an opportunity, and every future decline seems like a risk.
Yeah.
Meaning, like you look back and say, oh man, if only I'd bought in the global financial crisis, it would have been amazing. But then if you see that in the future and you see a 50% decline and you go through it, totally different experience.
Exactly. Yeah, the amount of times people say, well, just let NVIDIA pull back $50 a share. It pulls back 50 and they think that it's going to zero. They just think it's amazing.
Well, the amount of times that people email me or text me or I talk to them here, they'll say, Mab, I love your fund. They'll say one of a couple things. It's done great. I'm going to wait for it to pull back and then I'll buy it. And it never does.
Yep.
Or they say, Mab, I love your fund, but what's the opposite? I'm going to wait. They're always waiting, right?
Yeah.
Like the concept. And so I say, look, these are just excuses. It's like, I'm going to go on my diet tomorrow.
Exactly.
And I'm going to clean up. My favorite of all the examples, and I think we talked about this, is like, I'm going to clean out my garage tomorrow. And say, look at your portfolio. Pretend take out a blank piece of paper. Look at it. And if it's not what you want it to be, and if it's not the current portfolio you have, something is wrong. It's amiss. And so the garage is always the example we give. We say, look, go look at your garage. You won't, I guarantee you, if you bought a new garage, if a tornado takes out your garage, you build a new one, you won't go buy all the stuff you had in there prior. I'm talking the used mattress, the aquarium, the lawnmower. No chance. But that's what people do with their portfolio. They become emotionally attached, and then they just inherit a bunch of junk that's just clutter and sits there.
You reminded me of something I need to do. I knew my to-do list. I've had a storage facility in Baltimore for 3 years now full of stuff.
Yeah.
And the amount of money that I've spent to keep that stuff, I couldn't sell it for half of what I spent on it. And I don't even want that stuff anymore.
Yeah.
But there's something weird about it. I don't want to clean it out. So what areas of the world are you looking at? You know, obviously, emerging markets to me are just fascinating right now. I really like it. And I'm not saying they turn around tomorrow or next month. It could be a few more months of this, slogging around in the bottom. Are there any areas that really kind of jump out to you and your team?
Yeah. So we say, look, first of all, the starting point to everyone, to me, should be the market cap global portfolios. That's roughly 60% US, 30% foreign developed, 10% emerging. And I'm rounding. That's a starting point. Now, the average person has like 2% emerging markets. They may have like 5% in foreign. So already, they're not only are they 60% US, they're like 90.
Yeah.
And so just getting to the market cap weight, we think, and I love joking around with my Vanguard buddies because they put out these economic projections and they say foreign, developed, and emerging, best future performance they estimate, right? And I say, well, you guys aren't even to the market cap weight. And they say, well, yeah, but we can't tell our investors that because no one will do it, right? Like we get close. We're pushing them in the right direction. So look around the world. You can start with the broad indices, but again, market cap weight for us is suboptimal. So we always like to drill down. You can either do that bottom up, for our shareholder yield. You can do it top down with countries, but let's stick with countries. Yeah. It's a lot of emerging markets. Eastern Europe has been also a basket case for the better part of post-GFC. So you still have Poland, countries like that have really struggled. You have Singapore, you have Colombia, you have Brazil, on and on. I mean, UK got pretty screaming cheap in the last couple of years. Yeah. Buddy Rob Arnott was like, this is the trade of the decade. And usually UK versus US, like that's not an emerging market, right? They kind of go back and forth. But with Brexit and everything else, everyone got kind of worried about that, and that presented a huge opportunity. So most countries, to me, look great. I think the cheapest in the world currently, we send out a quarterly global valuation update where we rank them on the idea farm, which is free, as you know. And I think in the last update, Colombia was the cheapest on the list.
Really?
And we've told the story many times, but maybe not to your audience, is that, Colombia is a great example of sentiment shifting. I gave a talk in Bogota a decade ago, but the PE ratio there was like 40 or 50 or something. It was really high. And I said, look, amazing place, stock market's expensive, but everyone, when something is performing great and expensive, they give a million reasons why it's this okay. Yeah. And so they said, oil was at like 120. And they said, we got all this money, the pension funds, the government's flush. I say, look, great. But on average, these expensive markets tend to be more fragile. And I mean, I think the market's down 60%, since then, 80, I don't even know. Certainly on a real basis, even more. But looks great now, but the problem is nobody wants it, right? It's like if you do the attractive, cheap countries or opportunities, particularly where they've been underperforming for a long period, nobody wants them. And it's career risk. If you're a professional advisor and you recommend them and people say, well, you bought Colombia and Poland? Like what idiot would do that? So
yeah, like where's the upside as a manager, if managing doing that? Yeah. I love the country. I'm going back in January for a boys trip, which I'm not sure how they snuck that by the wives, but we want to do that in January.
Country.
Yeah, great country. How do investors invest in like a country like Poland or Colombia? Was one of your funds focus on those areas? Because I think the average investor is not going to go out and try to buy stocks like that. It's just not.
Unless you're Jim Rogers, right?
True,
Like the old school. You know, I think you can do a couple things. You could obviously just buy like Vanguard funds. We have 3 ETFs on the shareholder yield suite.
But can I cut you off? Like those Vanguard funds, like emerging market, the exposure to like a Columbia is going to be so small, won't it? Like it's not really going to move the needle.
One of the biggest problems, and we talked about this in my talk, is this concept of closet indexing, where you buy a fund and you pay how much ever, 0.5%, 1.5%, 2%, but then it just gives you like the S&P.
Yeah.
And that's true in foreign markets too. And so we say if you're going to charge more than 0, you want to be doing something concentrated, weird, and different. And that's uncomfortable for a lot of people, but over time, that's what you should be paying for, or else just buy the 0% fee fund. And so in our shareholder yield suite, we have SYLD, which is US, FYLD, which is foreign developed, and EYLD, which is emerging. And kind of what we talked about in the talk was we said, look, all 3 have the same approach. 100 stocks, long only, rebalance once a quarter. They're looking for stocks that have a lot of cash flows that pay them out through high cash dividends and stock buybacks. And we're agnostic as to how they do it. On average, the 3 of them usually end up with double-digit shareholder yields. And so that's a pretty astonishing number if you think about it. Because most people, when you think about dividends, you get excited if it's 4, 5, 6, 7. And we're talking double digits in the teens. And a lot of it in the US is through buybacks. A lot of it in foreign developed and emerging is closer to 50-50 dividends and buybacks. So they have a much bigger dividend yield. We want them to be trading cheap. And then we want them to not be funding it with debt. And so after that, the country, the sector allocation is agnostic. We set caps at 30%, so we don't want the whole fund to be in energy or tech or something. We don't want the whole fund to be in Poland or Taiwan. And so each one, it's fun to look at over history because the sectors will kind of oscillate, but true with the countries too. And so, for example, on the emerging market fund, we held no China for a long time. Or so I should say very little China. And China, for most emerging market funds, is like a third weight. Some it's 50%. But over the last couple of years where China has just been getting creamed, the stock market, it started to add exposure to China. And so now it's, I think, the number 2 holding in the emerging market fund. But it's saying there's a lot of value opportunity there. We'll see.
What would be number 1 right now? Do you know?
It goes back and forth between China and Taiwan right now.
Okay.
Yeah, which is an interesting,
I was going to say,
interesting barbell twosome there. But the opportunity shifts based on time and ditto in the U.S. with sectors and companies too.
I like that it's every quarter. I like that it's actively managed. Basically, you're out there doing that. And I think I've told you this 1,000 times. I own SYLD for clients for years.
Yeah. Well, hey, look, man. If you go back to a launch, it's now hopefully you bought in 2013. You've tripled your money then. But the cool thing about that is it's. Going back to the garage discussion, it's easy to become emotionally attached to companies. We held Apple from 2013 to 2020. I was so sad when the model was like, got to sell it, right? Because I was like, Buffett owns it, and it's it's just everything's going right, but the price along with the valuations kept going up, and so the fund is active, so it has a fair amount of turnover, but it can hold things if they perform for a really long time.
So what's the one fund, and I hate this kind of like picking your favorite child, I guess. Is there one fund in your suite of ETFs that you see right now today that like, man, this, I like this right here?
Yeah. So I'm terrible at these questions. I'm going to give you a couple answers.
Okay.
I think if you were to say Meb, the one fund you put all your money into, which is what I do, because public markets, I put all my assets into our ETFs, and the vast majority of it is dedicated to what we call a Trinity allocation strategy, which is meant to be the all-in-one. You want to put everything in one fund and be done with it. This is global allocation. It's got stocks, bonds, real assets. It's got tilts towards value and momentum. It's just everything in one fund. And that's TRTY.
Okay.
That having been said, if you're like Meb, Desert Island, gun to your head type of thing, I think for the past couple years, I would have said the emerging market shareholder yield. Now,
I think you said that last time.
Right, now, because it's cheap valuations, high dividends, everything is lining up to me to look great. Now, oddly enough, all 3, SYLD, FYLD, UILD, have similar valuation numbers, but the crazy part is the valuation spread to the overall markets has increased over the past 10 years, and it's across all 3. So to me, that's actually a pretty interesting setup. And I don't know that I've seen that in the past 10 years of doing this. So I still would probably say EYLD. That's my little non-consensus sort of view. But but I'm a trend follower at heart. And so our global momentum ETF, I'm just going to do the whole lineup at this point. Like, give me one. My last one is GMOM, GMOM. And that's meant to be a very concentrated momentum and trend fund. And it can be 100% cash and bonds, it can be 100% invested in gold, REITs, whatever. Right now, it's very heavy equities. It's got a smattering of foreign. And over the past few months, it's also been adding a pretty decent exposure to energy-related investments as well. Had a bunch of gold at the beginning of the year, tapered that down. I wouldn't be surprised if it adds it again. But it ends up, at times, being an oddball allocation, but has the ability to at least say, okay, everything's going down, we can move to cash too.
How often is that rebalanced?
Every 2 weeks.
Every 2 weeks. Oh, that's nice too. Every 2 weeks.
I mean, the trends tend to be longer term, and so there'll be things we hold for a long time in there. But if things change quickly, it'll adapt.
Good. Energy makes sense. I mean, energy stocks are looking good again, and the shit going on around the world. Like
we were saying earlier, we said energy a percentage of the S&P is down around 4%, but energy as a percentage of S&P earnings is triple that. Yeah. And so even if they double, it's not quite to where the economic impact is, which we think is a pretty interesting arbitrage or spread. We'll see if people get excited about them again, but it's hard not to be emotionally tied to cheering for one. I'm a Broncos fan, and so it's been a tough year, but I won't abandon them. But same thing with investments too. Well, no, but see, at this point I'm cheering for them, and I'm just cheering for them to lose to get a better draft.
Yeah, get Caleb Williams. I see where you're going with this, but. All right, Meb, again, thanks so much for sitting down with us. You might be the most frequenting guest right now. You might have just taken the lead over some of our in-house people. So again, we're coming to you live from the Stansberry conference out here in Las Vegas. We're going to wrap up this show today, but we have a lot more great interviews coming up in the next couple of weeks. Thanks again for tuning in. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.